All right, let's start the video with a question that could change your financial future. What would you rather have? $11,000 in monthly dividends or a $6 million portfolio? Let me be very clear. These aren't numbers I made up. They are the real projected outcomes of investing $100,000 in either SCHD or the S&P 500. Two ETFs, two completely different strategies, and two very different financial futures. If you chose the $11,000 in monthly dividends, you're thinking like an income investor, someone who values consistent cash flow and financial stability. But if you picked the $6 million portfolio, you're thinking like a total return investor, focused on maximum wealth accumulation. Today, I'm going to show you exactly how each path unfolds, and more importantly, which one might be right for you. And you might be surprised, the path that looks obvious at first isn't always the best choice for everyone. Let's start with the income investor approach. For this, we need to understand SCHD, the Schwab US Dividend Equity ETF. With over $88 billion under management, SCHD has become one of the most trusted names in dividend investing. And there's a very good reason for that. It is a carefully engineered portfolio of America's elite dividend-paying companies. What do I mean by elite? SCHD holds companies like Texas Instruments, who has raised its dividend every single year for nearly 2 decades. Chevron, who kept increasing dividends even when oil prices crashed. Coca-Cola, Merck, and Lockheed Martin, companies that dominate their industries and share profits with investors through consistently growing dividends. Here's how SCHD achieves this elite selection: by being incredibly picky about which companies make the cut. Out of thousands of dividend-paying stocks in the market, SCHD selects only 100. Its filter is so strict that companies need at least 10 consecutive years of dividend payments just to be considered. Then they need to prove financial strength, strong cash flow, low debt, and high return on equity to keep those dividends growing. What's impressive is how SCHD spreads your money across the economy. About 20% in rock-solid consumer defensive companies, 18.6% in healthcare, 14% in established tech. No single stock can exceed 5% of the fund. No sector can exceed 25%. You are owning the best dividend payers from every corner of the American economy. And notice something important. SCHD has 0 Magnificent 7 stocks. No Apple, no Microsoft, no Nvidia. 0. That one structural fact drives almost everything you're about to see. Over the past 14 years, SCHD delivered a compound annual return of 12.8%. That beats the long-run S&P 500 historical average of 10.5% a year. But more importantly, it grew its dividend payments by 11% every single year on average. That's not just beating inflation. It's building a growing stream of income that could eventually reach that $11,000 monthly figure we talked about. In just a moment, I'll show you the numbers. All this at a cost of just 0.06% per year. That's $6 for every $10,000 invested. Now let me show you exactly how these fundamentals translate into our $11,000 monthly income journey. Let's start with year 1. At SCHD's current dividend yield of 3.57%, your $100,000 investment generates about $3,570 in annual dividends. That's around $300 a month. Your portfolio is worth approximately $112,800. But here's where it gets interesting. Remember that 11% dividend growth rate I mentioned? This is where the magic starts happening. By year 5, your monthly dividend checks have grown to about $452. Not life-changing yet, but the compounding engine is already running. Your portfolio is now worth $182,000. At the 10-year mark, something shifts. Your monthly income has reached $761. That's larger than most people's car payments. And your portfolio has grown to $333,000. Year 20 is when things start looking very different. Your portfolio has crossed the $1 million mark at $1.1 million, and your monthly dividend income is approximately $2,170, coming in like clockwork, whether the market is up, down, or sideways. And finally, at year 30, here's what you've built. A portfolio worth $3.7 million, paying you over $11,000 every single month in dividend income. These aren't projections built on wishful thinking. They're built on SCHD's actual 14-year track record of 12.8% annual compounding and 11% annual dividend growth. Real companies, real cash flows, real profits shared with shareholders. Think about what $11,000 a month actually means. That's $132,000 a year, enough to fund a comfortable retirement, support your family, and never worry about a paycheck again. And it all started with $100,000. Now let me show you something completely different, the total return investor approach. This is where the S&P 500 comes in. And let me tell you, while SCHD's path to $11,000 monthly is impressive, the S&P 500's growth story is in a different league. We're talking about turning that same $100,000 into a $6 million portfolio. Before I show you how the S&P 500 achieves this, you need to understand what makes it so structurally different from SCHD. The S&P 500 doesn't have a philosophy. It has a system. It tracks 500 leading U.S. large-cap companies weighted by market cap. Whatever is biggest in America becomes the biggest position in the index. Right now, that means Apple, Microsoft, Nvidia, Alphabet, and Amazon, the companies reshaping the global economy, are sitting at the top. The S&P 500 doesn't try to pick winners. It lets the market decide. If Nvidia grows to 7% of the U.S. market cap, it automatically becomes 7% of the index. That is the power of market cap weighting. You always own more of what's winning. The top 10 holdings make up about 37% of the entire index. Most of them are tech or tech adjacent. That concentration is exactly why the S&P 500 has done what it's done over the last 14 years. And it's also a risk worth understanding. And here's the flip side of that SCHD stat. While SCHD has zero Magnificent 7 exposure, the Magnificent 7 makes up roughly 30% of the S&P 500. That single difference explains most of the 14-year performance gap between these two funds. Over the past 14 years, the S&P 500 delivered a compound annual return of 14.62%. That's 14 years through a bear market, a pandemic, and one of the biggest tech-led bull runs in stock market history. The result? $100,000 grew to $722,000 with dividends reinvested. All of this at an expense ratio as low as 0.03%. That's just $3 for every $10,000 invested. Here's exactly how this total return approach turns $100,000 into a $6 million portfolio. In year one, your $100,000 grows to $114,600. The dividend yield is only about 1.3%, so you're getting roughly $108 a month. But that's not the point. The point is price appreciation. By year 5, your portfolio has grown to $199,000, nearly double in 5 years, and it's already pulling ahead of SCHD in total value. At the 10-year mark, your portfolio reaches $396,500. That's about $63,000 more than SCHD at the same point. The compounding advantage is building. At year 20, the gap widens dramatically. Your portfolio is worth $1.57 million, nearly $460,000 more than SCHD. That is what 180 extra basis points of annual return does over 2 decades. And finally, at year 30, here's your reward, a $6 million portfolio. While it's not paying you $11,000 monthly in dividends like SCHD, you now have the flexibility to generate income however you choose, or keep letting it grow. A 4% withdrawal rate on $6 million gives you $240,000 a year. That's $20,000 a month. Of course, this journey isn't always smooth. In 2022 alone, the S&P 500 lost 18.3%. At a $1 million portfolio, that's a $183,000 drop in a single year. SCHD, by contrast, only fell 3.4% that same year, a 14-point cushion when investors needed it most. This is the S&P 500's real trade-off, higher long-run growth, but you have to stomach the swings. That's the power of owning America's growth engine, turning $100,000 into $6 million over time. But this path requires something specific from you as an investor. Now that you've seen both paths, which one should you choose? Ask yourself these 3 questions. 1. What helps you sleep better at night? Steady monthly income that keeps growing, or maximum long-term portfolio value? 2. Can you stay invested during a crash where your portfolio drops by hundreds of thousands of dollars without panicking? 3. Do you need income from your investments in the next 10 to 15 years, or can you let your money grow untouched? The best choice isn't about which ETF makes more money, it's about which path matches your financial goals and your actual behavior as an investor. Both paths can lead to financial freedom. They just take very different routes to get there. But here's something most investors never consider. These paths don't have to be mutually exclusive. Many smart investors hold both. They use SCHD for reliable, growing income while keeping a portion in the S&P 500 for long-term growth. When tech is running, the S&P 500 carries the portfolio. When markets get scared, like 2022, SCHD provides the cushion. Together, they cover each other's weaknesses. That's how smart investors think about wealth building. I'm Andrew. Thank you so much for being here. If you're interested in more comparisons like this, you'll love my recent video about covered call ETFs. The numbers in that one might surprise you even more than these did. Consider watching it, and I'll see you there.